Okay, so you've sent over some really interesting stuff about managing risk when it comes to investing.
Hmm.
And we're going to sort of try to get into that today
Yeah,
and, really try to help everyone listening kind of figure out how to think about all this stuff so
right.
that it doesn't feel quite so scary like walking a tightrope,
Absolutely.
because it can feel like that sometimes, right?
Yeah, for sure.
So that's our goal today,
That sounds good.
to make it more like a journey with a plan.
I like that. Yeah.
Something that you can,
Have a roadmap for.
yeah, a roadmap for and feel like you have some control over.
Yeah, exactly. And, I think a lot of times people get so caught up in, trying to get those big returns
Right.
that they forget about the other side of investing, which is
Protecting what you already have.
exactly, yeah,
Yeah.
protecting what you've built and understanding the risks that you're taking on.
Yeah, and that's such an important point. And, you use that image of the high dive,
Right?
which I thought was really cool.
Yeah.
Where there's that moment of like, whoa, okay, I'm up here and it's exciting and there's the potential for this huge splash,
Hmm.
but there's also that like, oh,
Oh, yeah.
what could go wrong here?
If I belly flop.
Exactly.
Hmm.
And so we want to try to give everyone listening like the tools
Yeah.
to kind of get up there and take that leap and feel a little bit more secure,
Yeah.
knowing that you have some strategies to manage the risks.
Hmm.
So let's just get right into it when we talk about risk management in investing.
Yeah.
What are we actually talking about?
So I think the simplest way to put it is that it's about, first identifying all the potential hazards out there, all the things that could possibly go wrong that can negatively impact your investments.
Right.
And then you need to try to figure out, well, how likely are each of those things to happen?
Yeah.
And if they do happen, how bad could it be?
Mm-hmm.
And then finally thinking about, okay, so what are the things I can actually do to try to minimize the chances of those bad outcomes or make the impact less severe?
So it's not just about trying to hit a home run with every investment.
No, not at all.
Mm-hmm.
Growth is definitely a big part of investing, right?
Right.
You want to see your money grow, but risk management is kind of like the guardrails
The guardrail.
that help keep you on track and prevent you from going off the cliff.
Okay.
It's about making sure that you're protecting your capital.
I like that.
Yeah, so it's like if you're building a house,
Right.
you wouldn't build it on a foundation that's all shaky and unstable,
No.
right? No matter how fancy the design is.
Right.
So risk management is kind of like making sure that you have that solid foundation for your financial future.
That makes sense. So where do we even begin to build that foundation?
Well, I mean, the sources that you shared,
Right.
they highlighted a few key areas.
Right.
And I think a great place to start is with this concept of diversification.
Yeah, diversification. And I think we've all heard that saying. Don't put all your eggs in one basket.
Don't put all your eggs in one basket.
Yeah.
It's a classic for a reason,
It is. Yeah.
but it really perfectly captures, I think, what diversification is all about.
Mm-hmm.
So in the world of investing, that means, not putting all your money into just one type of investment.
Right.
You want to spread it around.
Spread it around.
Put it into different asset classes. So your materials mentioned,
Yeah.
The typical examples, stocks, bonds, real estate,
Right.
things like that.
So the idea being that if one area of the market
Yeah.
takes a downturn,
Right.
your other investments are hopefully going to
Yeah,
help cushion that a little bit.
exactly.
Yeah, it's kind of like having different streams of income.
Oh, yeah.
If one of them dries up a little bit,
Mm-hmm.
you're not completely
You're not totally sunk.
sunk. Yeah.
Yeah. That's a great analogy, actually. Yeah.
Okay.
So by having, a mix of assets in your portfolio that tend to react differently to the same events,
Right.
you're essentially reducing the overall ups and downs of the volatility
Yeah.
of your portfolio. So, Warren Buffett, he's got a great quote
Mm-hmm.
about this. He said, never test the depth of the river with both feet.
I like that.
It's great, right?
Yeah.
And I think diversification is all about applying that same kind of cautious approach to your investments.
Okay, so spreading things out makes sense.
Right.
What's the next piece of this puzzle?
So the next really critical piece is all about looking inward.
Okay.
It's about understanding your own personal risk tolerance.
Okay.
And what that means is figuring out what level of market fluctuations
Okay.
and potential losses you're actually comfortable with.
And that's going to be different for everybody.
Right, absolutely.
Yeah.
Yeah, I mean, someone who's just starting out in their career
Right.
probably has a much different capacity for risk
Yeah.
than someone who's, maybe nearing retirement.
Closer to retirement. Yeah.
Exactly.
Okay.
And there's so many factors that go into that.
Right.
It's like What are your financial goals?
Right. Are you saving for a down payment next year?
Yeah, exactly. Are you saving for
Yeah.
retirement 30 years from now?
Right.
It all makes a difference. And then also, what's your investment timeline?
Mm-hmm.
How long do you have until you actually need to access this money?
Right.
So if you've got a long runway ahead of you,
Yeah.
you might be more comfortable taking on a bit more risk
Mm-hmm.
because you have time to potentially recover from any losses.
Okay.
But if you got a shorter time frame,
Right.
then you might want to prioritize protecting what you've already saved.
Right, because you don't have as much time
Exactly.
to recover if things
To make it back.
go south.
Yeah.
So it's not just about what the market's doing.
Right.
It's also about how those market movements are going to impact me.
Yeah, exactly. It's about how those ups and downs
Yeah.
are going to affect your own personal situation
Okay.
and your ability to reach your goals.
So this ties in, I guess, to...
Well, this is where Harry Markowitz comes in.
Mm-hmm. Okay, Harry Markowitz.
Yeah, he's the guy who basically revolutionized how we think about risk in investing.
Okay.
So he won a Nobel Prize for his work on what's called modern portfolio theory.
Oh, wow.
Yeah, it's pretty impressive stuff.
Okay. So modern portfolio theory.
Yeah, and the basic idea behind it is that, by combining different assets in your portfolio
Mm-hmm.
that don't all move in the same direction at the same time,
Right.
you can potentially reduce the overall risk that you're exposed to
Okay.
without sacrificing your potential returns.
I like that.
Yeah, so it really emphasizes the importance of aligning the risk profile of your portfolio with your own individual comfort level
Right.
so that you can find that sweet spot.
So it's really like a tailored approach,
Exactly. Yeah, it's
Yeah.
not one size fits all.
to each individual investor.
Yeah, everyone's different.
Okay, so we've got diversification, we've
Mhm.
got understanding our own, risk tolerance.
Right.
What's the third key principle we need to be thinking about?
So the third one is all about being proactive and continuously learning and staying informed about what's happening in the financial world.
Okay.
Because the markets, they're not static. They're constantly changing
Right.
and evolving.
Yeah, that makes sense.
So you need to stay on top of things.
Well, so what kind of things should we be paying attention to? Because it can feel like there's just this constant stream of news.
Oh, yeah, absolutely. I mean, think about things like, major economic indicators.
Okay.
So things like inflation rates, interest rate changes,
Mhm.
Employment figures.
Okay.
All of those things can have a big impact on your investments.
Okay.
And then you also want to be aware of, any major geopolitical events.
Yeah, that could create some instability.
Exactly.
Yeah.
Things that could cause, market instability or, sudden shifts in investor sentiment.
Right.
And then don't forget about technology,
Oh, yeah, technology is always changing.
always evolving,
Yep.
right? So you've got new innovations, new industries emerging,
Mm-hmm.
and all of that can, disrupt existing businesses
Right.
and investment strategies. So it's important to kind of stay ahead of the curve on that.
So it's not really a set it and forget it.
No, I wouldn't say so.
Find a strategy.
No, definitely not. I mean, having a long-term perspective is important.
Okay.
But you also need to be paying attention along the way
Right.
so that you can adjust course if needed.
Makes sense.
Yeah. I mean, your sources mentioned Ray Dalio and Bridgewater Associates.
Right.
And they're a great example of, folks who really understand the importance of staying informed.
Okay.
So they do all this deep analysis of economic trends.
Mm-hmm.
And they're really proactive about managing risk
Okay.
based on their understanding of what's driving the markets.
So they're not just reacting to the headlines.
No, they're trying to anticipate what might happen.
They're trying to figure out what's underneath.
Exactly. Yeah, they're looking for those underlying drivers.
The market movements.
Mm.
And this is where it gets really interesting because your sources also highlighted some historical lessons.
Mhm.
And I think the 2008 financial crisis comes to mind immediately.
Absolutely. Yeah, that was a huge wake-up call.
Yeah, a major event that showed us just how important
Yeah.
risk management is.
Yeah, I mean, it was a really stark demonstration of what can happen when risk management fails on a large scale.
Right. So what happened there?
Well, basically, you had this whole combination of factors.
Okay.
You had this interconnectedness of the financial system
Right.
where everybody was kind of tied together.
Hmm.
And then you had this underestimation of the risks in the housing market.
Right.
And it all kind of snowballed into this global financial meltdown.
Yeah.
And investors around the world lost a lot of money.
Yeah, it's kind of sobering to think about how,
It's pretty scary.
widespread
Yeah.
the impact was.
Yeah, and it really brought this concept of systemic risk to the forefront.
Systemic risk.
Yeah, so that's basically the risk that, the failure of one part of the system
Right.
can trigger a cascade of failures throughout the whole
It's
system.
like a domino effect.
Exactly. Yeah.
Yeah. Okay, so that's systemic risk. And then there's this fascinating stuff from behavioral finance.
Oh, yeah, that's one of my favorite areas.
Okay.
So behavioral finance is all about how our emotions
Okay.
and our psychology
Right.
can actually influence our investment decisions
Okay.
and our perception of risk.
So it's not just about the numbers.
No, not at all.
Mm.
I mean, we like to think of ourselves as rational,
Yeah.
but the truth is that, we're all human and we're all influenced by our emotions.
Right.
So, for example, investors often exhibit what's called overconfidence.
Overconfidence.
Yeah, which basically means they think they're better at predicting the market than they actually are.
Oh, yeah.
Yeah, we all tend to think we're, smarter than the average person.
Right.
And that can get us into trouble when it comes to investing.
Okay.
And then another common bias is, underestimating risk during bull markets.
Right. When everything's going up.
Exactly.
Yeah.
When everything's going great,
Yeah.
we tend to think it'll last forever.
Yeah.
And we get complacent. But then when the market inevitably turns,
Right.
we panic
Yeah.
and we sell everything.
And usually at the worst possible time.
Exactly. Yeah. And that's how people end up locking in losses.
Right.
So this disconnect between our perceived risk tolerance
Okay.
and our actual risk tolerance can be a real problem.
Yeah. So basically what you're saying is our gut reactions might not be the best guide
Yeah, sometimes our gut can lead us astray.
when it comes to
Yeah, especially when it comes to risk.
managing risk.
Yeah,
Okay, so this is why it's so important to have a plan.
absolutely.
To have that,
A strategy.
yeah, a risk management strategy in place.
Yep.
That's based on
Based on your goals,
Mm-hmm.
your understanding of your own risk tolerance,
Mm-hmm.
and, a realistic assessment of the markets.
So that when things get crazy,
Yeah.
you're not just reacting emotionally.
Right. You have something to guide you.
Yeah, some kind of framework.
Exactly.
So these historical events
Right.
and these insights from behavioral finance, they really show us
Yeah, they highlight.
why all of this is so important.
Mm-hmm.
Okay, so we've talked about diversification,
Yep.
understanding our own risk tolerance, staying informed.
Mm-hmm.
And we've looked at some examples of why all this really matters.
Mm-hmm.
What's the key takeaway here?
I think the main thing to remember is that, effective risk management isn't about trying to avoid all risk completely,
Okay.
because that's just not realistic. And to be honest, it's not even desirable.
Because you need to take some risk to actually grow your investments.
Exactly. Yeah. I mean, taking calculated risks
Right.
is a necessary part of achieving your financial goals.
Okay.
So it's more about understanding the specific risks that you face
Right.
and then actively managing them in a way that makes sense for your own individual situation.
So it's not about being reckless,
No.
but it's also not about being so risk averse
Right.
that you miss out on opportunities.
Exactly. Yeah. It's about finding that balance.
Finding that sweet spot.
Yeah.
Okay.
And it's not a one-time thing either.
Right.
It's an ongoing process.
Yeah, because things are constantly changing.
Exactly.
Yeah.
Yeah. So as your life changes, as the market evolves,
Yeah.
you need to continuously learn and reassess your risk tolerance.
Right.
And adjust your strategies accordingly.
This has been really helpful.
Oh, good. I'm glad.
So now for you, the listener,
Right.
we want you to take a moment and think about what we've talked about today
Yeah.
and think about your own investments.
Yeah. Think about your own portfolio.
Yeah. What are your initial thoughts?
Yeah. What comes to mind?
Yeah. So here are a few questions to get you started.
Okay.
How well have you diversified your portfolio, across different asset classes?
Have you really thought about, what would happen
Yeah.
if the market took a big downturn?
Right. A sudden drop.
Yeah.
How would you feel?
Mm.
How would you react?
Would you panic?
Yeah.
Would you stay calm?
And does the way you're currently invested align
Right.
with how you think you would react?
Yeah.
And then another thing to think about is how actively are you actually staying informed
Mm-hmm.
about what's going on in the financial world?
Are you paying attention?
Yeah. Are you paying attention to the things that could impact your investments?
Yeah.
So, we're not trying to overwhelm you with these questions.
Mm.
It's more about, giving you some starting points.
Some food for thought.
Yeah, exactly. Some food for thought.
Yeah.
So that you can kind of evaluate how you're approaching things right now.
Hmm.
So, maybe there are some areas where you could diversify a little bit more.
Yeah.
Or maybe you haven't really sat down
Yeah.
and honestly thought about your risk tolerance.
You know what would happen if things went really bad?
Yeah.
Really think through those scenarios.
Yeah.
And then, are you making an effort to stay updated
Yeah.
on all the things that could influence your investments?
Because that's going to help you make better decisions.
Exactly. Yeah.
Yeah.
And, build a more resilient portfolio.
Okay, so bottom line, we've learned that risk management is crucial.
It's fundamental.
It's a fundamental skill
Yeah.
that you need to have
If you want to be a successful investor.
if you want to be successful at this.
Yeah.
Yeah, and it's not just about, protecting yourself from the downside.
Right.
It's also about being able to pursue your goals, with more confidence.
Exactly. Yeah. It's about having a plan and feeling comfortable.
Right, and knowing that you're not going to be completely derailed if things don't go exactly according to plan.
Yeah.
So it's really an integral part of your
whole
whole investment strategy.
Yeah, I think of it as, kind of like a foundation
A foundation.
that you build everything else on.
Okay, I like that.
Yeah.
So one last thing for everyone listening to really think about,
Okay.
based on everything we've talked about today, about managing risk.
Yeah.
What's one specific thing that you could realistically do
Yeah.
to adjust your own investment strategy?
In the near future.
Yeah, in the near future.
What's one actionable step
Yeah, one actionable step.
you could take?
And what additional research maybe do you need to do to feel good about making that decision?
What other information do you need to gather
Yeah.
to feel confident?
So we hope this deep dive
Yeah,
has
sure.
given you some things to think about.
Some food for thought.
Yeah, exactly. And thanks for joining us.
Thanks for having me. This was fun.
This was great. Yeah.
Yeah.
We'll see you next time.
Sounds good.